This week, we're going to switch gears from discussing fiscal policy and Keynesian perspective, and we're going to begin looking at money and monetary policy and the Federal Reserve System. And this is a departure from what we have been doing over the last several weeks, dealing with things relating to fiscal policy. Before we begin discussing monetary policy, really we need to begin discussing what money actually is, how it works, what it functions as, and then we'll explore a little bit about what's known as the Federal Reserve System. So money is something that you're probably familiar with. I would imagine that you've encountered it for quite some time in your lifetime. And yet you may not have fully grasped all the different functions of money. We most of the time think of money as having a medium of exchange, but there are a couple of other functions that we're going to discuss. So for money to really work, we will use it as a medium of exchange in a way that we can exchange some kind of currency for another currency or for another good or service. So we tend to think of dollar bills and coins as our medium of exchange. I do like the book presents a little bit of discussion about other forms of currency around the world, and in particular from the island of Yap in the South Pacific. They used at one time very large stone wheels was their medium of exchange. So essentially, in order to make this work, you just have to have something that can be used to exchange for the items that you desire to purchase. Whatever that something is, you simply exchange it for the things that you desire to buy. That's our most common use of money. But we do use money in other functions, but we may not really realize what it is that we're doing. So, for example, if you go to the restaurant and you see the menu, and the menu says a chicken sandwich is $5.99 and a beef sandwich is $6.99 and drinks are 99 cents. Just looking at the menu means that really we're not exchanging anything yet. We're just looking at the menu and we're looking at prices. Well, what prices are is a mechanism that's called a unit of account. So essentially, the unit of account allows us to compare the value of one item relative to the value of another item. So for example, if drinks are about $1 and French fries are about $3, I realize that, well, apparently the drink is about a third of the value of the French fries. Or you could say, for my $3, I can get one order of French fries, or I can get 3 soft drinks. So money serves as our medium of exchange. It serves as our unit of account. It also has what's known as a store of value. So what this means is that it retains its usefulness over a period of time. So the purchasing power might be different, but it's still money. So for example, if you put money in a jar and you left it in the jar for 5 years, it would still be some coins in the jar 5 years later. And assuming that the United States was still taking quarters, you could use it. Now, you might not be able to buy as much with that quarter, but you would still have it as a monetary system. Or alternatively, consider this. Have you ever washed a bill? You ever realize that what comes out of the washing machine is not a pile of shreds, it's just a clean dollar bill. It has retained its purpose as money. Now, it may not retain its value over time, but it will retain its purpose as money. So money serves these three different functions: a medium of exchange, a unit of account, and a store of value. So the book asks these two questions. Are credit cards money? What about checks? Well, consider this. Do we ever exchange a credit card for something that we desire? All the time. Do we ever write a check for something that we desire and exchange the check for the good that we're buying? Some of us still do that. Not everybody writes a check. But consider this, is the check or the credit card actually money? Really what those things represent is a way to transfer money from one account to another account. The money is what's in the bank account. The money is not the actual check. So I have known several people who use the phrase, well, I must have money because I still have some checks. Well, they just have pieces of paper. The check doesn't represent money. The deposit in the bank account represents money. So again, I talked about the island of Yap. So this is an island in the South Pacific. And at one time, they created a monetary system in which they went to adjacent islands, pretty remote islands. This was hundreds upon hundreds of years ago. And they would quarry out these round stone wheels. They'd carve a hole in the middle, and then they would put it back in the dugout canoe and paddle back to the island of Yap. And the stones were the currency on the island of Yap. Any idea why they put holes in the middle? So then they could put a stick in the middle and use it and wheel it out of the jungle and onto the boats. So this served as their medium of exchange. It also served as a unit of account. So for example, if you were to purchase a hut or a piece of land on the island of Yap, you would know that, well, the hut is worth a quarter of a wheel and the land is worth half of a wheel. That's your unit of account. Obviously, it has store of value because the wheels still exist hundreds of years later. And interestingly, the island of Yap still uses this currency in symbolic exchanges of very large sums. They do have a paper and coin system like the United States does. They've developed that recently, realizing that these wheels really aren't all that efficient in terms of having them as the source of money. So we tend to look at different types of money and whether they're liquid or illiquid. And the two types of money that we look at are what are called M1 and M2 money. You know, those aren't really creative names, but they represent different forms of money. And what's included in these calculations of money range from things that are very liquid, like cash and coins in your pocket, to things that are not very liquid. It's not so easy to spend. Things like a certificate of deposit. So M1 money includes all of the currency and coins that are out there. It includes our checking deposits. It's not the check, it's the money in the bank. That's money. I know that if I have a checking deposit, I have a piece of paper that says how much money I have in the bank. That's part of M1 money. And it also includes traveler's checks, because traveler's checks are fairly easy to use if you have them. Now, if you look at the amount of M1 in circulation, it's been increasing very steadily since the 1990s. And since the last recession, it increased very dramatically. in terms of the amount of money that was in circulation. So if we look at the numbers, there's around $5.5 to $5.6 trillion worth of M1 money. So remember, that's coins and currency, checking deposits, and traveler's checks. Currency is about $2 trillion worth. And interestingly, of that $2 trillion, almost half of it is actually held by people outside the United States. It's often a common form of currency in many transactions, particularly in the developing world. Most of our M1 money is in checking deposits, so it's the amount of money that's in the bank. There's a little bit of traveler's checks, but not many people use traveler's checks these days. So M2 money includes all of M1 money, plus it adds on top of that some money that's not so liquid. So for example, savings deposits. Interestingly, there are savings accounts that you can't necessarily just deposit a bunch of money in your savings account and have immediate access to it. You might have to wait a day for that transaction to be processed, for the money to actually become available. There's also things called money market funds. It's a type of fund that gets you a little bit more interest than a savings deposit, but it has some limitations on it. So for example, you might not be able to withdraw money, but a couple of times a year. And so that's a limitation on a money market fund. The same with small scale time deposits. So these are things like CDs. So for example, if I were to purchase a 90-day CD, essentially what that means is I'm going to lock away my money for 90 days. I'll get some interest when I cash it in at the end of 90 days. So a CD is a time deposit, and we generally look at time deposits less than $100,000. So again, you'll notice M2 money has been rising very rapidly since the 1990s. And if we look at the actual calculations, there's almost $19 trillion of M2 money. Now remember, almost $6 trillion of that is M1 money. And then we add on to M1 money the savings deposits and the small scale time deposits. We add that on, and then we get M2 money. So interestingly, in our country, we at one time had several hundred different currency systems. Every state had their own currency system. Sometimes every bank had their own money system. And what that led to was a great deal of concern about how the money was operating in the United States. So this was in the 1800s. And there were a series of financial panics through the 1800s. And in particular, in 1907, there came to be a massive financial panic. And they realized that the United States really didn't have anything that was overseeing the money supply. We had at one time the first national bank in the colonial era. It didn't last very long. We had another national bank that was created under, I think it was Alexander Hamilton, but it didn't last very long. And really there's almost was free reign in terms of money. And there was no entity that controlled the money supply in the United States. So by 1913, they created the Federal Reserve Act, which created the Federal Reserve System. So the Federal Reserve System was actually an entity that has three different parts to it. Essentially, when Congress created the Federal Reserve System, or it's most often called the Fed, When they created the Fed, they did not want just one person in charge of the money supply in this country. They felt like that was too much power. So they wanted to have some checks and balances in the system. So the first thing they created was what's known as the Board of Governors. So the Board of Governors consists of 7 members, and each of them serve for 14 years. And there is a chair of the Federal Reserve System. And that chair serves a period of 4 years and then has to be nominated and approved again. So the Board of Governors consists of 7 members, and these members are appointed by the president and approved by Congress. So there's a little bit of checks and balances. And the other thing that was created was that the members of the Board of Governors, they rotate every 2 years. So it's not like in any one given year, all 7 of them are gone. Everybody serves a 14-year term, and every 2 years, someone's term expires. And then the president appoints and the Senate approves. Now, the chair is also appointed by the president and approved by the Senate. So I'm going to give you an opportunity for 2 bonus points. 2 bonus points if by Tuesday morning at 11 o'clock, so this is going to be Tuesday, October 27th at 11 o'clock, if you will email me the name of the current chair of the Federal Reserve System. And I'll just be honest, I gave you the picture. So moving on, the Federal Reserve System not only has the Board of Governors, but they took the country and they divided it up into a variety of regional banks. Now, the purpose of a bank is to accept deposits, to make loans, and to make a profit. Well, these regional banks operate just like regular banks, and they're often called the banker's bank. So, for example, if you were a bank in Paducah, Kentucky, you would have an account at the regional bank. And the regional bank, there are 12 regions in this country. In Western Kentucky, our regional bank is in District 8, and it's in St. Louis. It's in downtown St. Louis is our regional bank. So the regional bank sort of oversees the banking businesses within its particular region. The Board of Governors sort of sets the vision. The regional banks kind of monitor the banks in their particular districts. So we have the Board of Governors, the 12 regional banks, and we also have what's called the Federal Open Market Committee. So the FOMC consists of all the members of the Board of Governors, the president of the Federal Reserve Bank District of New York, and 4 of the other regional bank presidents. So remember, there's 12 regional banks. One of them always is on the FOMC, and that's really because the actions of the FOMC happen through the Bank of New York. And 4 other of the remaining 11 banks have representatives, and those seats are all rotating. So everybody has a seat at the table at some point in time. So the easiest way to think about this is that the Board of Governors has the vision. The 12 regional banks provide the on-the-ground perspective as to what's happening in the economy. And the FOMC conducts what are known as open market transactions. And we'll discuss these in a later chapter, but essentially this is how the vision gets actually implemented. And this is where the money supply actually is controlled through the FOMC. So what we have is a mechanism in which there's a variety of power that's shared across a variety of entities. So we ask, well, what really does the Fed do? And their first and primary mission is to control the money supply, both physically, but also psychologically. Physically, the physical currency that we have, our dollar bills, for example, when they become really degraded, ripped and torn and old, the Fed is the entity that is going to ultimately get rid of those bills, pull them out of circulation, they shred them up, and they will order new money to be printed by the Treasury Department. So they control the money supply from a physical sense. They look for counterfeited money and control that. If they encounter counterfeited money, they contact the Secret Service. The Secret Service really is ultimately responsible for prosecuting counterfeit crimes. But the Fed also psychologically controls our money supply. So if you look on a dollar bill, you'll recognize that the dollar bill has a statement on there. And the dollar bill says, this money is legal tender for all debts, public and private. What that means is our money is not backed by gold, it's not backed by silver, it's not backed by anything. It's simply backed by our faith in the system. And we have that confidence in the system because there is an entity that's looking out for the system called the Federal Reserve. So the creation of the Federal Reserve created a mechanism whereby we can have some confidence that somebody is looking out for this system. For example, the Federal Reserve is going to go into the banks and they'll ask the banks to show them the books. Show us what your deposits are. Show us what your loans are. Make sure that you're not making loans that are too risky, that are not going to be paid back, and you would lose your deposits. So the Fed primarily gives us confidence. The Fed does a little bit of the clearing of the checks, not as much as they used to. In the old days, when you wrote a check, it ultimately went to a Federal Reserve bank, and they processed the check and made the transaction between banks. Nowadays, it's pretty much automated and subcontracted out to a lot of different entities. The Federal Reserve also regulates the banks. So one entity is the Federal Deposit Insurance Corporation. So for example, your deposits in your bank are guaranteed. They are insured. The bank takes out an insurance policy such that up to a certain amount of deposits, if that bank went under, you would get your money back. You would not lose your money. That's what happened in the 1800s and the early 1900s. Banks would go under and people would lose their deposits. Well, the Fed makes sure that doesn't happen anymore. The other thing that the Fed will do is they'll make sure that the credit industry is also regulated, in particular to make sure that there is no discrimination. So, for example, they might go to a bank and say, show us where your loans are being made. And they might look at the characteristics of the people who are taking those loans out. And if a bank is demonstrating discrimination, the Fed will step in and ensure that that bank loans money to everybody that is qualified to borrow. The days of discrimination in terms of loans, those are now illegal. We're not allowed to discriminate in terms of making a loan. We can ask them what their job is, do they have income, what their assets are, that sort of thing. But we simply cannot say to a person, I'm not going to loan money to you because I don't like the house that you're buying. That would be discrimination. The Federal Reserve also sort of monitors, if you think about it simply, the government's checkbook. They make sure that the federal budget is being followed. They also have several places around the country where they will store gold, not because gold is what backs our currency, but because gold is a valuable asset, and the Fed actually controls a chunk of gold. So the Fed has vaults around the country in which they will store gold, and they'll actually store gold for other countries too. So in terms of what the Fed does, they look out for our money supply. And so we examine what really is money. What are the functions of money? It serves as a medium of exchange, a unit of account, and a store of value. And we also examined the structure and the purpose of the Federal Reserve System. We looked at the three different entities that make up the Federal Reserve System, and we looked at some of the actions of what they actually do. In the next chapters, we'll examine how the Federal Reserve actually conducts what's called monetary policy. So I challenge you, as you move forward in just your day-to-day activities and you go and purchase something, think about what that money is that you're actually spending.